Hello, this is Yee Real Estate Network. This is SeeWing Yee. Thank you for attending. And this podcast is strictly for real estate investors, probably mom and pop type of investors, right? So you guys are working full time, make about $100,000 a year on the average. You will have $50,000 or $100,000 or maybe more to invest, uh, to buy investment properties in different part of the country, perhaps mainly single family homes. These are in my knowledge, in my opinion, single family home residential investing is the best multi-dimensional historical proven asset class in the world in history. So with that said, today's podcast, I'm going to talk about the four numerical formulas that may break your real estate investing career. It will make or break. All right. So, with that in mind, let me share the screen. And here we are. And let me proceed accordingly. All right. So, they are, I know the terms may be a little bit technical, but I will do my best to break it down in a layman's terms, meaning I will try to explain it as simple as possible. What I found over the years that many real estate investors, whether they are newbies or experienced investors, they do not necessarily follow any or some of these very critical numerical formulas. I know there are many aspects of real estate investing, and I simply do not have time to go over all the criteria for real estate investors. But let's for this podcast, just I'm gonna focus on the four formulas. All right. So without further ado, the uh, the first one is the 1% rule. It is called rent to value ratio. 1% rule. If you were to buy a single family home residential investment property for, let's say, $250,000, you multiply by 1% or maybe slightly less, given what's going on with the real estate investing world these days, with the real estate appreciation, uh, record breaking situations in the past 12 to 18 months. But maybe slightly less than 1% rule. If you okay, when you buy investment property for $50,000 and they're out there, those are ideal candidates. 1% rule. I mean, you need to have a 1% multiplied by 50,000 is $500. Okay, gross monthly rent. If you buy $100,000 property, 1% multiplied by 100,000, then you have $1,000 monthly gross rent before deductions. And if you buy a property for 150,000, you may not get 1%. You may get like 0.07 of 1%, which is around $1,200. If you buy a $200,000 property, uh, you're not going to get 1%. You can get 0.06%. For $200,000 property, you can collect around 1,500 to 1,550 monthly gross rent. You will achieve monthly positive cash flow with financing. Another assumption I'm using is you're going to put 20 to 25% down financing. This is the true way, the best way to buy investment properties is to get a loan, qualify for investment loan financing, 20 to 25% down payment, and the 1% rule or 0.07 or 1% applies. All right. And the other technical definition is capitalization rate. The capitalization rate is the net operating income divided by the purchase price. Okay, I will explain later. Okay, and the third scenario is cash on cash return. The cash on cash return means it's the annual cash flow divided by the initial cash invested. All right, and finally, the fourth formula is total return on investment, which is the annual gross equity income divided by the initial cash invested. All right, I don't want to sound too technical, but bear with me. I will do my best to explain this to you. All right, follow along. Okay, let's break it down the benchmarks, right? The four formulas. Let's recap that. Like I said, 0.07% to 1% is the benchmark for successful purchase of investment properties. Single family home, duplex, triplex, and fourplex. I don't want to go anything beyond that because this is the best asset class to buy, right? In my opinion, all with all these years of helping investors. And then the cap rates. The capitalization rate is sort of a commercial rate return on investment, not projecting the mortgages, the financing aspect of it. So the benchmark with the capitalization rate is 5%, around that price range for anything for that are like 150,000 or higher. Uh, Cap rate 5% would be the benchmark. For any kind of property that are $100,000 or less, you can get 7% cap rates. Okay. Uh, anyway, I'll discuss that more later on. So typically, 10% cash on cash return would be ideal benchmark, and then cash on cash return. If you can get 15% cash on cash return, that is really above the benchmark for success, right? So so therefore, if you so there are two school of thought. There are two geographic location in the U.S. where you can create your real estate portfolio of single family homes and duplex, triplex, and fourplex, uh, something like that, right? And they are the Midwest market, and then there are the South and Southeast market. Those two regions of the U.S. is the best for investing, all right? Because the numbers works. Do not pursue the other regions, not the Northeast, not the West, not the Northwest, not the Southwest, because those investment properties are too expensive. The rent will not match the price of those properties, right? Does it make sense? The number in those areas does not work. So if you want to buy one or more rental properties, doesn't matter. The best way to do a turnkey approach, use the services of a turnkey provider. You can do that in a very efficient way with the property management, the whole one-stop shop. That's an ideal business model, right? Having said that, the Midwest, you can buy property with a low price, with a low acquisition out of pocket, low down payment that is, with very high cash flow, right? You can achieve financial freedom using strictly those kind of properties in the Midwest for very high passive income down the road in the future. But if you want to buy properties that are higher cost, $250,000 to $300,000, uh, you should buy in the South and Southeast. In those areas, you can buy new constructions or resale homes that are relatively new with a better neighborhood, better appreciation potential, but the cash flow is not as high. As you can see on my slideshow right here. All right, so those are two school of thought. Diversify among the Midwest for high cash flow properties, offset by buying properties in the South and Southeast in the US to achieve lower cash flow because that's the way it is, right? The rent will be, 0.06 to 0.07% or 1%, which is rent to value ratio on those higher priced homes, new constructions or newer resale homes in the South and Southeast, for example, right? You can see at the bottom of this slideshow for some more details. So let's go on. Where to buy? Like I said, you buy for, population growth and job growth, right? So that's how it is. You can sprinkle some high-tech markets along with that. In a medium-sized city, at least a couple of 100,000 people, that'd be ideal. Job and population growth. That is the big picture. I'm not going to go over too much detail. You will know on this slideshow. So a typical Midwest market where the prices are very low, you can still get financing. I will briefly go over the rent to value ratio. This property located in Midwest. This property is a single family home selling for $47,500, I believe, right? And the rent over here, as you can see, is $850. So this older home in the Midwest, good cash flow, is more than 1%, right? I mean, you can look at, I know the number is kind of small. If you look at the top of this worksheet, of this pro forma, if you will, the rental value ratio is quite high. It's like 1.8%. So it's really, it's a cash flow market. So, all right. So right off the bat, and then you want to calculate capitalization rate, right? If your capitalization rate is, as I said, is quite high here also, which is 13.2%. I mean, this is really off the chart, right? And then the cash on cash return is extremely high. The cash on cash return is 32%. That means your net cash flow, right? The net cash flow with financing, you're putting 20% down financing here. So here's the total monthly debt obligations. This is your gross rent, 850, and you're financing this property, and monthly mortgage is over here. So your net operating income minus your debt obligations, your monthly net cash flow is very, very high, which is $330 is your monthly net cash flow. Gross rent minus your monthly debt obligations, your mortgage, your taxes, your insurance, your property management fee equal 350, right? Net monthly. You multiply by 12 months, so your annual net cash flow is $3,961. That's almost $4,000 annual net cash flow. And then your down payment. Look at your down payment. Your down payment you put in, a total, as you can see right here, is $12,500. So $12,500 divided by $3,961, your cash on cash return is, as indicated, which is 32%, right? That means in about 3 years, 32 plus 32 plus 32, at the end of the third year, assuming the assumptions are correct, numerically speaking, you can recoup all your down payment, right? So 32% cash on cash return on the financing of this purchase is very, very high number, high benchmark, which is very, very good. All right, so anything that are more than 10% cash on cash return is considered, meeting the benchmark for a good cash flow property. But in this case, in this particular Midwest property, is amazing. So imagine that, yeah, your total down payment is only $12,500 at 20% down, right? And then on an annual net cash flow, you're almost getting 4,000, right? So very simple formula, right? So the 3961 divided by your down payment, 3961, your annual net cash flow divided by your down payment, 12,500 equals 32% cash on cash return, right? I mean, by using leverage, this return on investment at the end of the first year is astronomical. So anyway, all right, that's all I have to explain the rent to value ratio and the cash on cash return, and the capitalization rate is way higher than 5%. So you buy, like I said, I don't want to spend too much time. So you buy in the Midwest market, right, with lower costs, blue collar market, Midwest, what Midwest, right? Ohio, Illinois, Missouri, Tennessee, upstate New York, Michigan. Those areas are considered Midwest market. Older homes, a lot cheaper, but the rent is higher. So if you want passive income for retirement, you buy yourself a whole bunch of homes in those markets in about long-term 5 to 10 years. Depending on how much down payment you have, you can buy multiple properties from this Midwest market strategy. Then you could potentially replace your working income, right? Again, it all depends how much money you have to do the financing. But some of you still would like to buy in the higher price market, newer construction, better markets, better quality of tenants, and better appreciation potential. So they are in southeastern United States, mainly Florida, Texas, and North Carolina, although there are a few other areas that may work, but this is the primary one. Okay, all right, as you can see on my slideshow. So let me skip over this a little bit. Let me fast forward. So Texas and Florida and North Carolina is the best area to buy new construction. They are, more costlier. They cost like, given today's market, they cost at least 220,000, 250,000, even $300,000. They are brand new construction, single family homes. Some are newer resale homes, but the rent to price ratio is not as high, but the appreciation potential is a lot higher. So you try to mix between those two strategies, right? Buy in the emerging market, higher cost, lower rent to value ratio, but higher appreciation potential, and then offset that by buying in the Midwest market with lower price, but much older homes. I mean, they are rehab, you buy it from a very good turnkey provider that will do the all rehabbing for you, get the property management, those kind of things, right? I mean, buy turnkey, those kind of things. If you can find the right one, of course, we have the right ones. All right, and let me see. Let me fast forward to identify one of the property I want to show you that are in the south and southeast that may make sense for you. So bear with me. This uh, so I already show you the lower cost property in the Midwest, very high cash flow. Now this is a pro forma. This is a pro forma means the cash flow analysis on a monthly or annual basis. So this property is a typical property, brand new construction, or newer resales in the south and southeast market, better neighborhood, better asset class, uh, and so forth, so on. But they cost, in this case, in Texas, 181,000 brand new construction is probably more now. This pro forma was done maybe a year ago, and prices have gone up quite significantly since a year ago. But this property a year ago, 2020, the year like 181. Purchase price is a brand new construction, and it rents for between 1595 to 1625, right? So a little bit less than 1% rent to value ratio, but it's going to cash flow, right? So you factor in, I'm not going to go through number by number, but you look at the monthly taxes on the lower left-hand corner, monthly insurance, monthly property management fee, some 5% vacancy factor, right? So it goes, and then you do a financing of 20% down payment, I think, right? And then you still come up with a net cash flow at the lower right-hand corner of $316.76. So it's not too bad. So the cap rate is 5.32%. It meets the benchmark, and the cash on cash return is 5.25%. So you're buying for high appreciation potential the next couple of years in this, in this kind of market, emerging market in Texas in this example. But lower cash flow relative to down payments, right? So your how much is down payment is so your down payment at the lower left-hand corner at 25% down payment is 45,000 plus closing costs of a few $1,000. So your total out of pocket is around 50,000, and right, and your annual net cash flow is around almost $4,000. So not bad, but the appreciation potential maybe 7 to 10% annual appreciation for the next couple of years, given the trends of the market, especially here in Texas, in Austin Metro, by the way, in Central Texas for that matter. So this kind of property, but the appreciation potential is strong. So you buy the offset. All right, does it make sense? So anything else? I think that's it. I don't want to spend any more time. So I just to recap, I kind of show you the four numerical formulas, but the most important thing is 1% rent to value ratio. And then for property that are less than 100 grand, for property that are more than $100,000, you're not going to get the 1% rent to value ratio. You might get 0.06 or 0.07 or 1% ratio. As long as you figure this very simple formulas, you will achieve positive cash flow. So that's the key, right? Buy for positive cash flow. And the secondary objective is to get some appreciation. So you have a total return on your investment which is in the double digit areas. All right. So rent to value ratio 1% or slightly less, and then capitalization rate of 5 to 13%. That's the benchmark to achieve cash flow, and then cash on cash return of at least high 7, 8, 9%. If you buy in the higher price point South and Southeast markets of the U.S., but if you buy in a lower cost Midwest market, so your cash and cash return could be anywhere from 10 to 20 to even 30%, as the example that I illustrated to you. I hope I'm not talking that fast, but I'm trying to give you some highly conceptual, basic terminology. So this is the foundation of your criteria, your evaluation of what properties to buy to achieve cash flow and appreciation as you build your real estate portfolio. So as a mom and pop investor, right, you work very hard in your life. If you want to overcome the rat race, you need to venture into real estate investing. And this is kind of ideas that I'm teaching you of how to do this. All right. So thank you so much for attending. And this is SeeWing Yee from the Yee Real Estate Network. All you have to do is just at the bottom of my video, you click subscribe. You will receive monthly newsletters, videos about more about real estate investing in the way that we do it, turnkey, buying remotely out of state, passively, let the property manager do everything for you, right? And so you can build a real estate portfolio with very minimal time out of your hand. You can continue to work full time on your regular job, focus on what's important to you, and delegate everything to your team, property managers, realtors, tax accountants, title companies, and insurance agents to help you to monitor your properties over time. All right, I think that's all I have. Hopefully you have received good value from this video. Thank you for attending. This is SeeWing Yee from the Yee Real Estate Network. Have a nice day. Bye-bye.